There was some respite on the Australian share market today. The good news is it dropped only slightly, although the Reserve Bank intervened to keep a floor under the dollar at around 61 US cents. One big reason the dollar is being dumped on financial markets is because of Australia's reliance on its resources boom to help stave off the recession now threatening America and Europe, and because commodity prices have also been forced down by the global slowdown. Even China's miracle economy has slowed to 9%, and its insatiable hunger for Australian iron ore to feed its steel mills, effectively keeping the economy relatively buoyant, is also diminishing. But will Chinese growth be able to resist pressures enough from without and within to save Australia from the worst impacts of the global crisis? Greg Hoy reports.
Along with economic reform, China become stronger and stronger.
There is now an economic changeover or economic baton turnover from the west to the east, and it's been more apparent probably in the last couple of months.
The quarry for a hungry tiger. The rapid urbanisation of China's 1.3 billion people now consumes 85% of global steel consumption, with 50,000 new skyscrapers planned in 200 new cities within 2 decades, plus highways, railroads and 97 airports before 2020.
In 10 years' time, we will be looking, if China maintains its growth pattern of 8 to 9%, we'd be looking at China being the largest economy. And we're talking between the World Bank forecasts or UBS forecasts, China is actually looking to outstrip United States GDP by 2015 on a currency-adjusted basis. And we're looking at around 20 trillion USD in GDP.
China's tiger economy has been roaring ahead at a voracious 10 to 12% growth rate for 5 years. So by holding onto the tail of the tiger, by feeding the furnaces of Chinese steel mills as the biggest supplier of iron ore, coking coal and steaming coal, Australia's terms of trade have soared by 50% in 4 years, hoisting the trade balance into surplus, lifting Australia's gross domestic income by 32%, emphasising the interdependence of the tiger and its quarry.
Now China and Australia enjoy a very good cooperative relationship. The economy between our two countries are strongly mutually complementary.
Yet fear on global markets that the China boom will soon bust as the downturn from the credit crisis bites the world economy has seen BHP Billiton stocks fall 39% this year, Rio 58%, dragging down the Australian share market and the Aussie dollar from a near parity high of 98 cents in July to just 60 cents today.
They don't want commodity-based currencies. We've seen a significant fall in global commodity prices. This is likely to have a very significant impact on the Australian economy.
Publicly, the Chinese government has appeared stoic.
We are very confident to maintain a steady growth in our future economic development.
But privately in China, there's growing concern.
If you're travelling with someone from the government in your company, they are much more cautious about what they say. But I have the impression that some Chinese businesses are now starting to suffer and to have reduced sales and to expect further reductions in sales.
Visiting Beijing, Professor Alan Fells is a long-time observer of the Middle Kingdom, where for years he's advised the Chinese government on business reform.
Even if the Chinese economy continues to expand and have a strong demand, you will find that the collapse of demand in the rest of the world will tend to bring down the prices which can be charged to Chinese businesses by our exporters.
So have the markets got it right in downgrading all things Australian so markedly? Or could they have overreacted by prematurely pronouncing the death of the resources boom and abandoning the Australian dollar? For starters, according to the Bureau of Resource Economics, most Australian supply contracts were negotiated in American dollars at prices locked in until March of next year. So there's a temporary cushion. But as regards the inevitable slowdown in China from the frenetic pace of recent years, while pessimism still pervades jittery markets, there is a rousing chorus of bulls in the China shop who say the end is not as nigh as the markets would have us believe.
I think this year it'll do a bit better than 8 or 9% because already in the first half of the year growth's been over 10%. I can't see it falling so precipitously in the second half of the year, but even growth rates of 8 or 9% will still deliver quite substantial increases in income. And certainly China will continue to present itself as a strong export destination, particularly for Australian exporters.
Chinese growing rate is go down. I believe this is abnormal. Of course, Chinese cannot keep always on the forever very high growing rate. This is not possible.
China's main source of its GDP is still internal domestic demand. For the last calendar year in 2007, 91% of its GDP was actually generated from within the country.
And that's a reminder that China has cycles just like everybody else. But even if they slow a lot, it seems to me that they will pick up again in due course and probably grow pretty quickly on average over many years.
And there remains an even bigger and more volatile challenge overshadowing the impact of the credit crisis.
The main issue within China would still be polarization, which is the systematic difference between the rich and the poor. There's still a population of 1 billion which is classified to be poor, and there's a very, very small population, albeit 20 million, which are classified as super rich. Now, what's happened is that over time, if that disparity keeps increasing between the poor and the rich, what we'll see is we'll start to see some level of civil unrest.
There's no doubt income differential is growing and is seen by the central authorities as a major policy objective to address. And I think that's going to be one major reason, as well as trying to prevent any rise in unemployment, why the central authorities will work to ensure that China's growth rates remain quite robust by any international standard.
And no question they've got the money to do it and are prepared to use it.
China has a massive treasure chest worth 1.8 trillion US dollars, of which approximately a trillion of that is invested in US Treasury notes.
China could half save the world if it stepped up consumer spending by releasing more money into the economy and by boosting public spending.
The great demand for Australian resources, it seems, is far from finished.